We're on location in Singapore at the International Energy Week. I'm Arnold Gay. Now, the plunge in carbon permit prices in the EU and the somewhat bleak expectations for climate talks in Durban later this month have cast a bit of a pall, if you like, over carbon prices and carbon markets trading. But Barclays Capital still thinks that the market will be worth about $2 trillion by 2020. For more, I'm joined by Trevor Sikorski. He's a carbon markets analyst with Barclays Capital. Trevor, thank you very much for joining us. Despite those numbers, which were probably released a little bit earlier, you're a little bit pessimistic about what's been happening in carbon markets of late.
Yeah, certainly the immediate term's been very difficult in the carbon market. So you've seen prices come off. Part of that's the macroeconomic risks we see in Europe. The debt crisis obviously playing very, very heavily on investors' worries, as well as, you've had very good supply of allowances into the market and of permits into the market as a whole. So a very weak demand side in Europe, very strong supply side, and that's reduced prices. And I think on top of that, there has been some pessimism about the expansion of emissions trading outside of Europe, and that's played on the market sentiments as well.
How long do you see these depressed conditions, if you like, going on for?
Well, I think they could be around for a while, because what's happening in Europe at the moment is we're building up a fairly good-sized inventory of carbon allowances and carbon permits, which will then have to kind of grow into and, emit more carbon in some ways to use up that inventory. And that inventory will be around for a while. And really, it's going to take a few years for us to get through that. And there's a very big risk that that inventory gets bigger if Europe plunges into a second recession, because what those recessions does is it reduces industrial output. By reducing industrial output, you reduce emissions. Those industrial participants don't use up their allowances and they sit on them. So they become longer and longer, and you get more and more supply coming into the market. So I think it could be a while. We're looking at maybe a 2 to 3 year period where we think prices will be really, really modest before we get some pickup.
Our market's positioned to recover strongly, though, by 2015. That's about 2 or 3 years' time. We're going to see Australia part of the global trading emissions system. Is that going to be significant for this part of the world?
Well, I think it's going to be helpful. And what's going to tie Europe and Australia together is they both use CERs, as certified emission reductions, which come out of the UN, so they're the UN offset spaces. And so it'll create an additional demand for that. That'll help tighten up that market, take some of the supply out of Europe, put it somewhere else. That is going to be good for the market as a whole. And, I think seeing additional schemes is really going to renew some confidence, in the market, in the ability of the market to deliver emission reduction gains.
Two of the biggest players in carbon emissions, the US and China, have not shown any signs of being part of this scheme. I mean, how big of an obstacle is this going to be for the rest of the world to, if you like, sign on and be part of this global trading emission scheme?
Yeah, I think the US and China are very different in some ways, both in their approach to international carbon markets. In terms of the US, there has been a complete failure and unwillingness to engage in the wider international carbon market. And indeed, you are seeing some cap and trade schemes being developed on a regional basis. The most notable one, in fact, the only one, is California. California will start trading from 2013. It will not use international offsets, though, in the market. It will only use North American-based offsets. So it is very different. It is much more kind of, insular to North America than the other schemes. Now, China has interacted in the market because it's been a big host of CDM projects. So a lot of the CRs issued, generated, used come from emission reduction projects in China, but they don't provide any demand. They just provide, if you'd like, supply into the market. And what you need is an emitter as big as China to start producing some demand to help out the market. But again, I think, and it's very different from the US, where there's no real plans for national cap and trade. The Chinese are talking about studying and indeed implementing some form of national cap and trade by 2015.
Okay, Trevor, thank you very much for that. That's Trevor Sikorski, carbon markets analyst at Barclays Capital. I'm Arnold Gay for Reuters.